Hello friends, how are you? I hope all of you are doing really good. So, one of the most asked for chapters by the CMA students for the revision purpose is standard costing. Students are saying, sir, rest of the chapters are fine, we can do it on our own, right? Only few chapters are left so that you can just revise. There is nothing much in that. One important chapter that everybody has been fearing is standard costing. So the student says that, sir, please cover standard costing. Okay, so we are going to cover the standard costing in this series now. Let's start with standard costing. Now, this is an interesting chapter, I would say, very interesting chapter. Now, what is standard costing, sir? Whenever you are going to do some work, what will be the first step? The first step will be you will set standards. Right? For example, if you want to complete a chapter for revision, the first thing that you will do is you will set the standards that in these many hours, I will try to complete this particular chapter, right? And after that, after you have completed the task, these standards are done before the start of task. And once the task is completed, you will try to compare the standards with actuals. You'll try to compare the standards with actuals, right? And if there is any difference between what you thought of and what actually happened, that is known as variance. That is why the standard costing is also known as variance analysis. This is also known as variance analysis. If there is any difference between the standards and the actuals, that means it is known as variance. You need to find out the reason for the variance and then you need to take the corrective action regarding that variance, right? So in standard costing, when we talk it from the business point of view, we have to study the variances, the various variances we have to study. What are those various variances that we'll be studying? One is related to the material. Material means the raw material, right? Then we are going to study about the labor variances. Then we will study about the overhead variances. In the overhead variances, we have variable overheads and the fixed overheads, right? And after that, one set of variances will be related to the sales. Clear? One set of variances will be related to the sales. Now let's try to cover it one by one. The first segment that we are going to take is material variance. First, we are going to take material variance. So for the material variance, I have already told you how to prepare the table, right? I'll just explain it quickly. The first thing that you have to do it whenever you have completed a work, now you want to compare the actuals with the standards, right? Now, let's say you have thought of manufacturing. You have thought of manufacturing standard. Okay, I'll write it as standard output. Standard output of FG. Standard output of FG is 1000 units, right? That means you thought that you will prepare 1000 units, but the actual output was 900 units. Now you will have to compare the standards and the actuals as per this 900 units. That is the actual output, because whatever the actual expenditure has been done, the actual cost has been incurred, that is on 900 units. That means now you need to find out what will be the standards for 900 units and compare it with the actuals of 900 units. That is why when we are preparing the table, the first thing that we calculate is standard quantity. Standard quantity means how much of the quantity of the raw material has been consumed for actual output. For actual output, that is for 900 units, right? If for 1000 units you have thought that the raw material consumption will be let's say 1000, for 900 units it will be 900. The standard quantity for actual output, what is the standard rate? From here you will get standard cost for actual output. After that, the actual quantity, after that the actual rate and the actual cost, right? The standard quantity for actual output, standard rate, standard cost for actual output, actual quantity, actual rate, and the actual cost. Now everything is for 900 units. 900 units is my actual output. So you need to find out everything, because only then can you compare the standards of 1000 units with the actuals of 900 units. No, that is not a meaningful comparison. So you have to find out what is the standards for 900 units and then compare it with the actuals of the 900 unit, because the actual expenditure is done on the 900 units, sir. Right? The actual expenditure is done on 900 units. Clear? Now, how to calculate the various material variances? What are the various material variances? The first variance is direct material cost variance. Direct material cost variance is standard cost for actual output minus actual cost, right? What is standard cost? This minus this, right? Sir, how do we find out that why we are keeping the standards first and then actuals afterwards? One simple rule that you have to remember: whatever the thing should be more, right, it should be kept first. Now we say the standards should be more in terms of the cost. We have thought of what are the standards. What you thought of, you are thinking that in the making 1000 will be the cost, but actual cost is 900. So it is beneficial, right? So whatever should be more, it should be kept first. That is why here we are keeping the standard cost for actual output minus the actual cost. In terms of cost, we say the standards should be more, actual should be less, then it is beneficial for the business. Clear? After that, direct material cost variance, then we have direct material price variance. Direct material price variance is standard price minus actual price multiplied by actual quantity. That whatever the actual quantity you have purchased, what is the price variance on that, right? On the actual quantity, if you apply it by the standard price and if you are applied by the actual price, what is the variance due to the price part? So you have to be careful with one thing. You have to take the actual quantity here, not the standard quantity. Please be very careful with this thing in the examination. Direct material quantity variance, that is standard quantity minus actual quantity multiplied by standard price. Clear? This will be your quantity variance. Now, all these variances can be calculated if you have one raw material or two raw material or three raw materials, whatever. If you have more than one raw material being used in the process, then what you have to do, you will have to prepare the table again. In that case, the table is standard quantity for actual output, standard rate, standard cost, actual quantity, actual rate, actual cost, and one more column will be added, that is revised standard quantity. One more column will be added, that is revised standard quantity. On this side, you will take material A and material B, right? Let's say the standard quantity for actual output is 40 kg and 60 kg, total 100 kg, right? Standard rate is 2 rupees and 3 rupees. So here it is 80 rupees and here it is 180 rupees. Clear? After that, what is the actual quantity that is used? Sir, actual quantity used is, let's say 45 and 70, right? 45 and 70 is the actual quantity, that is 115 kg that is used. What is the actual rate? Actual rate, let's say, is 3 rupees and 4 rupees. So what is the actual cost? 45 multiplied by 3, 135, right? And 70 into 4, that is 280. This is the actual cost. Now, how to calculate the revised standard quantity? Revised standard quantity is the distribution of actual quantity in this ratio, in the ratio of 4:6, right? That when we distribute the actual quantity, the total actual quantity in the ratio of standard quantity for actual output, right? So 115 divided by 10 multiplied by 4, that comes to 46 here, and 115 minus 46, that is 69 here, right? 115. So this becomes your revised standard quantity. This is how you have to calculate the revised standard quantity, right? Distribution of total actual quantity in the ratio of the standards. In this ratio, in 40:60, simple, that is your revised standard quantity. Now from here you can calculate two more variances. From here you will be able to calculate direct material mix variance. Direct material mix variance is revised standard quantity minus actual quantity multiplied by standard price, and direct material yield variance, that is standard quantity for actual output minus revised standard quantity multiplied by standard price, right? Now, for the examination purposes, you will have to remember a few things, because in the examination, you cannot just sit back, relax, and think of the logics first, and then you can apply the formula. You don't have that much of a time in 3 hours, right? So you have to remember these things. Whenever it is a mix variance, that how you are mixing it up, then revised standard quantity minus actual quantity into standard price, and in case of yield variance, then standard quantity minus revised standard quantity into standard price. So these are the variances regarding the materials, right? These are regarding the material. Now coming to the next one, the next one is regarding the labor. The next variance is regarding the labor variances. The next one is regarding the labor variances. Okay, in case of labor variances, now what we have to see, in case of material, we say what is the quantity that is consumed, what is the rate of that raw material, and accordingly the cost. But in case of labor, what is the cost dependent upon? It is dependent upon the number of hours for which that labor is working, and it is dependent upon the rate which we are paying to the labor, right? So that means if you want to prepare a table here, again the number of hours will be calculated for the actual output. Again, the role will be of actual output, right? Actual output, let's say it is 900 units. So you have to calculate what is the number of hours, what is the standard number of hours as per the actual output, what is the actual time taken, that is the actual hours for this actual output taken by the workers, right? And then you can compare it. Otherwise the comparison is not possible. So we prepare the table as standard hours for actual output, then standard rate, standard cost, right? Actual hours, actual rate, and actual cost, right? So from here we can find out the variances similar to how we have find out there, right? So what will be the variances here? The direct material cost, direct labor cost variance, direct labor cost variance, that is standard cost for actual output, that is this one, minus the actual cost, that is this one, right? After that we have direct labor rate variance. Rate variance is standard rate minus actual rate multiplied by actual hours, right? Be very careful here, you have to take the actual hours and not the standard hours. That what is the actual hours you have paid for, what is the rate difference due to that, right? Now again, one very important point that you have to remember here when we are talking about, when we are talking about this actual hours, this actual hours can be actual hours paid or actual hours worked, right? Which one you have to take? Sir, you have to take this one. It is quite a possibility. What is the difference between the two? Sir, you paid for 100 hours, whereas the worker actually worked for 90 hours, right? You paid for 100 hours, whereas the worker actually worked for 90 hours. What is the difference between this, the 10 hours? Why there is a difference? Because of the idle time. Sir, the worker was having the lunch, the worker was waiting for the job to be switched. So all these things that comes under the idle time. The 10 hours is your idle time. So whenever you are calculating the rate variance, you have to take the actual hours paid and not the actual hours worked, right? The next variance that we have is, you have to remember it very carefully, that is direct labor efficiency variance. Now when we are calculating the efficiency will be judged on the basis of what is the standard time, what is the time that should have been taken, and what is the time that actually has been taken by the worker, right? That is standard hours for actual output minus actual hours multiplied by standard rate, right? Now again here, when you are talking about the actual hours, here you can take either actual hours paid or you can take actual hours worked, right? Sir, at many places you will find out that they have calculated it using the actual hours worked, because they say efficiency is judged on what actually the number of hours he has worked, right? So actual hours worked and actual hours paid, you can take any of these in case of efficiency variance. In case of rate variance, it has to be actual hours paid for, right? In case of efficiency variance, you can take worked also or you can take the paid one also. But remember one thing, if you are taking the actual hours paid here, that is absolutely fine. Here in case of efficiency variance, you are going to take actual hours worked, then in this case your direct labor cost variance is equal to direct labor rate variance plus direct labor efficiency variance. This will not hold true, right? Nothing to worry, but this equation will not hold true in that case. But if you take actual hours paid here, then this equation will hold true. This you have to remember, because in the examination sometimes you might get confused. Sir, I'm taking it correctly, and this is one way of verifying the answer, whether this equation holds true or not. But if you take actual hours worked here, then this equation will not hold true. It is very clearly mentioned in the books also, right? Especially in the CA module, it is clearly mentioned that if you will take actual hours worked, then this equation will not hold true. So you have to remember it, right? Now, if there is more than one worker, one type of a worker that is involved, for example, there is an unskilled worker, there is an unskilled worker, and there is a skilled worker. So there are two types of workers who are involved, who are being paid at the different rate, right? So the table will be same as we have done it in the material. The table will be something like that. That is standard hours for actual output, right? Then we have the standard rate, then we have standard cost, then we have actual hours, actual rate, actual cost, and then we have revised standard hours, right? You have to calculate the revised standard hours. For example, the standard hours for unskilled is 100, for skilled is it is 80, right? Rate is being paid at 1 rupee and 2 rupees, that is 100 rupees and 160 rupees. Actual hours taken is let's say 105, and here it is taken 75. Actual rate that is paid is 0.5, and here it is 2.5, right? So something like that you can just, this is just an example, otherwise 52.5, and here 75 multiplied by 2.5, it will be 187.5, right? Total hours taken here is 180. Okay, I'll have to change this. Let's say it is actually it is taken 85, right? So actual hours here will be 190. 190, here it is 180, that is the standards, and 85 multiplied by 2.5, that is 212.5. Now how to calculate the revised standard hours? So revised standard hours will be calculated distribution of this 190 in the ratio of 100 is to 80, right? So 190 divided by 180 multiplied by 100, that comes to 105.5, right? And 190 minus 105.5, that will give you 84.5. Clear? This is how the revised standard hours will be calculated. Any doubts in this thing? I hope this much is clear. Now there is from here what you can calculate, sir. You can calculate the other two variances, that is direct labor mix variance. Direct labor mix variance, what will be that? That is revised standard hours minus actual hours multiplied by standard rate. And then you can calculate direct labor yield variance, that is standard hours for actual output minus revised standard hours multiplied by standard rate. Clear? This is your direct labor yield variance that you can calculate. Now, one very important thing that you have to remember here, that is idle time. How to treat idle time in this case? How to treat the idle time? Sir, the idle time will be given in the question. Idle time will be given in question, right? Idle time will be given in the question. If idle time variance. He says to calculate, sir, idle time variance will be equal to idle hours multiplied by standard rate. And if this kind of a situation occurs where you have unskilled and the skilled labor, right, then what you have to do, just listen to it very carefully. This actual hours is what is it is paid for. This is the actual hours that you have paid for. If the idle time is given to you, how you have to treat it, listen to it very carefully. If the idle time is given, you will take idle hours. You will take idle hours for both unskilled and skilled. Let's say for unskilled it is 10 hours and for skilled it is 8 hours, right? Then if you subtract the idle hours from this actual hours paid for, what you will get is actual hours worked for efficiency variance, right? That is 105 minus 10, 95, and 85 minus 8, that is 77. This is what you will get for actual hours worked for, which is used for the calculation of efficiency variance, right? This is the role of idle hours. Now, if here it is asked to calculate the idle hours variance, then how will you calculate it? Sir, this idle hours multiplied by standard rate, 10 into 1, 10 multiplied by 1, that is 10, right? And 8 multiplied by 2, that is 16, total 26. Right? This will be what? This will be your idle time variance. Clear? This is how you have to treat the idle time in case you have the multiple types of labor. Right? If you have unskilled labor, if you have skilled labor, this is how you have to deal with it. So this is all about the labor variances. After that, we have the overhead variances. Now, after that, when we talk about, sir, the overhead variances, next we'll talk about the overhead variances. In the overhead variances, we have two types of variances. We have two types of variances. One is variable overhead. One is variable overhead and another thing is fixed overhead. Now, how to deal with the overheads? One thing we have studied in the chapter of overheads, sir, we absorb overheads, right? Here also we are going to absorb overheads. We are going to absorb overheads. Now here we can absorb it on two things. One, we can absorb it on material cost or we can absorb it on labor cost, right? There is no other thing on which we can absorb it as per the standard costing. Clear? So first we are going to discuss about the variable overheads. First we are going to discuss about the variable overheads, which is very, very simple. Variable overheads, which is very, very simple, sir. Variable overheads is nothing, absolutely. Now, if in most of the cases, in 99% of the cases, the absorption will be on the basis of labor hours, right? In most of the cases, the absorption will be on the basis of labor hours. So how will you deal with it? The table will be same as we are going to prepare it in the labor costing. That is, right? That is standard hours for actual output. What is the standard rate? What is the standard cost? Now here the rate is variable overhead rate. Variable overhead rate per hour. It is not the labor rate. It is not what we are paying to the labor. Here the standard rate means the variable overhead rate per hour. You have to be very careful with this thing. Do not take the labor rate here per hour, right? That will become your labor cost. Here we are talking about the variable overhead cost, right? Then you have the actual hours, actual variable overhead rate and actual cost. This is what? This is your actual variable overheads. Now in the question, if it is given the labor rate also and the variable overhead rate also, while making this table, the standard hours for actual output will be same in both the cases, but the standard rate will be different. In case of the labor variance table, the standard rate will be the rate which we are paying to the labor, right? That is the labor rate. But in case of the variable overhead, the standard rate will be the variable overhead rate per hour. So you have to be very careful with this thing. This is one very common mistake. Okay, so with this we can calculate the variances. Very simple, sir. The variances are variable overhead cost variance, variable overhead cost variance, that is standard cost for actual output minus actual cost. Right after that, variable overhead rate variance is there. Rate variance is what? Standard rate minus actual rate multiplied by actual hours, right? And then we have variable overhead efficiency variance, that is again the standard hours for actual output minus actual hours multiplied by standard rate. Clear? The same way as we have calculated it for the labor variances, the only difference that it is for the variable overheads. Clear? So the variable overhead part is very simple, sir. Now coming to the fixed overhead, sir. The fixed overhead is little bit typical. Fixed overhead variances. Fixed overhead variances. Right? Now, again, in most of the cases, these variances will be these variances will be absorbed on the basis of labor hours, right? Let's say now what you thought for. Let's talk about your thought process, standards. You planned that your standard output will be 1000 units, right? Your standard output will be 1000 units. And what will be your standard hours? That will be 2 hours per unit, right? What will be your standard rate? That will be rupees 2. After that, what actually happened, sir? What actually happened? Your actual output was 900 units, right? And the actual rate that is given, what is your actual rate? What is your actual rate? Actual rate is, let's say, 3 rupees, and actual hours that is taken here is 3500 hours. Right? Actual hours that is taken, sir. Not 3500 hours. It will be too much. Let's say 2500 hours. Right? Now, how to prepare the table in case of fixed overhead variances? This kind of a information, let's say, is given to you. Now, what we call it as, this is call it as budget. Budget means what you originally planned for, including the output, right? Standards also, we call it as standards also, we call it as budget also. Now let's see how the table is going to be prepared in this case. In this case, we will say standard hours for actual output, standard rate, standard cost, actual hours, actual rate, actual cost. Now in this case, 3 more columns will be prepared, that is budgeted hours, budgeted rate, and budgeted cost. You can prepare it in just one line. I don't have a space. Clear? The first rule is that you have to start with this data. This data in most of the cases will be given to you. In most of the cases, this data will be given to you. This data is what? Sir, budgets relate to the hours and the cost related to the budgeted output, what you originally planned for, not for the actual output. Not for the actual output. What we say, this budgets represent what we actually planned for. We actually planned for what will be the budgeted hours as per the actual planning. As per the original planning, the budgeted hours will be 1000 into 2, that is 2000 hours. Isn't it? 1000 units multiplied by 2. What is the budgeted rate? 2. What is the budgeted cost? 4000. Right? Then this should be your first step in most of the cases if the budgeted information is available to you. Then the next step is this budgeted rate and the standard rate will be same. Then now you can calculate standard hours for actual output. How you can calculate? What is your actual output? 900 units. What is the standard hours per unit? 2 hours per unit. Right? So what will be your standards here? 900, that is the actual output, multiplied by 2, that is 1800. Right? So what is your cost here? That is 3600. What is the actual hours that is taken? 2500 hours. What is the actual rate? 3 rupees. Right? So I think it is too much that I have taken. It's okay. 7500. Clear? This is how the table will be created. First, start with the budgeted data. Then this should be your second step. Then this should be filling up. This should be your third step. Then this should be your fourth step in case of the fixed overhead variances. This is how you have to try to fill up this table, right? Now, what is this part represent? This represent the absorbed overheads. How do you calculate the absorption of overheads? How do you absorb overheads? Remember, in the overhead costing, how do you absorb the overheads, sir? Overheads are absorbed. That is the rate. This is what? This is the absorption rate multiplied by the actual output, the data for the actual output, right? So this is known as absorbed overheads. 3600 is absorbed overheads. This is your actual overheads incurred. This is your absorbed overhead. This is what you originally planned for. What you originally planned for. Clear? This is how the fixed overhead variance is to be calculated. Okay, now what are the various variances that are to be covered under this? First is the fixed overhead cost variance. Fixed overhead cost variance, that is standard cost for actual output minus actual cost. This is the first one. Second one is fixed overhead budget variance. Fixed overhead budget variance, that is budgeted cost minus actual cost, right? So you just have to remember a few things now here. You will have to remember a few things now here, right? After that, the fixed overheads volume variance. Fixed overhead volume variance, that is standard hours for actual output minus the budgeted hours multiplied by standard rate, right? After that, we have fixed overhead expenditure variance, right? Fixed overhead, now efficiency variance. Fixed overhead efficiency variance, not expenditure variance, that is standard hours for actual output minus actual hours into standard rate, right? Then we have the fixed overhead capacity variance. Fixed overhead capacity variance, that is actual hours minus budgeted hours into standard rate. Now, what is this capacity variance, sir? What is the capacity variance? The capacity variance says that what is the capacity of the worker to work for. We thought of that the worker can work for only 1000 hours, whereas the worker actually worked for 1200 hours. So what is beneficial in this case? Actual hours should be more than the budgeted hours. That shows he has a capacity to work for a more number of hours. That is why the actual hours have been taken first and then the budgeted hours, right? That is what I told you, that whatever is beneficial, whatever should be higher, and that higher value is beneficial, right? Like we say the cost should be higher, the actual should be less, then it is beneficial. Here we say the actual capacity, the actual number of hours, that shows the actual capacity of the worker should be higher than the budgeted capacity, right? Now, one thing you have to remember in this case, if it is given, if the number of days, let's say he says we planned for, what is the standard? The standard is the worker will work for 25 days in a month, whereas actually the worker has worked for 27 days in a month, right? Now, if this is given in the question, then shortly you can calculate the calendar variance. Then you can calculate the calendar variance here, right? What is that calendar variance, sir? What is that calendar variance? That is fixed overhead calendar variance. Fixed overhead calendar variance is possible hours minus budgeted hours into standard rate. Now, what is this possible hours, sir? What is this possible hours? The possible hours is the standard hours for actual number of days. For actual number of days, right? If the standards are set for 25 days and now you need to find out what is the standard for 27 days. Clear? Any doubts in this thing? Right, sir? So possible hours is that, let's say for 25 days, if you say the standard hours is 1000, so what will be the standard hours for 27 days? This is how you will calculate. this is how you will calculate the possible hours. It will be 1000 divided by 25 multiplied by 27. That comes to 1080 hours minus the budgeted hours into standard rate. Right. After that, the last one that we have is fixed overheads, revised capacity variance. Now this revised capacity variance will be calculated only and only if you have the fixed overhead calendar variance. If you have fixed overhead calendar variance, that means this 25 and 27 days are given to you, only then and then you can calculate the revised capacity. That is actual hours minus possible hours multiplied by standard rate. This is your revised capacity variance, right? So this is all about the fixed overhead variances. This is one of the most important parts, right? This is one of the most important parts. I hope this much is clear. This is very, very important, sir. Very important. Now, coming to the last part, that is the sales variances. Sales variances is comparatively simpler. It is there in the paper number 10, right? But I'll cover it here also. Sales variance. Sales variance. Now, what should be the table for this? The table will be the standard quantity which is sold, not the for actual output. Sir, we are talking about output here, right? So simply, what is the standard quantity? What you planned for that this many units of this product we are going to sell? Simple, right? And what is the standard selling price at which you planned for? What is the standard sales value that you planned for? What is the actual quantity that you have sold? What is the actual selling price at which you have sold? And what is the actual sales value that you have done? Here again, if more than one product is being sold, then revised standard quantity will be there. Revised standard quantity will be there. So what will be the variances here, right? The first variance will be the sales value variance. Sales value variance, right? Now what is the sales value variance? The sales value variance says that what should be more, the actual sales value should be more or the standard should be more. What is more beneficial in terms of sale? Now we are not talking about the cost, we are talking about the sales. What is more beneficial, having more actual sales value or having more standard sales value? Obviously, sir, if the actual sales value is more than what we planned for, it is beneficial for the business, right? So here it will be actual sales value minus the standard sales value, right? So this is the first part. After that, the second one is the sales price variance. The sales price variance, right? So in this case, this is going to be actual sales price minus the standard sales price multiplied by actual quantity. What is beneficial? Having more of actual sales price is beneficial, right? Then the next is sales volume variance. Volume variance or quantity variance are one and the same thing. That is actual sales quantity minus the standard sales quantity multiplied by standard sales price. What is beneficial? Selling more number of units is beneficial, right? And if more than one product is being sold, then we can calculate the sales mix variance also. Sales mix variance, right? That is revised standard quantity minus actual, in this case, it will get reversed. Actual quantity minus revised standard quantity multiplied by standard selling price. And in case of sales yield variance, in case of sales yield variance, it will be revised standard quantity minus standard quantity into standard selling price. So in case of the sales variances, it will be the reverse of the cost variances, right? That means in the cost we take the standards first and then the actuals. Here we are taking here the actuals. When we are talking about the sales, the actuals should be more than the standards. Clear? So this is about the sales variances, and on the similar lines you can calculate the sales margin or the profit variances. That is exactly same on this, exactly same, only in that case here you will take the standard profit right? And the standard total value of the profit, actual quantity, actual profit, actual value of the profit, and the revised standard quantity, that is absolutely same. And the sales margin, value variances, price variance, volume variance, mix variance, exactly same. Right, so this is all about the standard costing. You have to remember the small things which we have discussed in this lecture. If you want to go through again, you can go through again. I have discussed everything of the standard costing. The rest is, or you already must have practiced all the questions, right? So guys, just prepare well for the examinations. All the best to all of you. Just stay calm during the examination process. That is the most important thing, because the more you will keep calm, the more you will be able to attempt in a better frame of mind, and the lesser will be the chances of committing the silly mistakes. Because one area where we lose marks the most is the silly mistakes, the calculation errors. Where it is to be written per unit, we will take the total value. Where it is to be taken the total value, we'll write it per unit. So these are the small areas that you need to work on, right? So rest of the chapters, if it is okay, you can prepare it, you can just go through it. Marginal costing is simple, sir, right? You just have to remember all the formulas is not that is concept only. PV ratio, break even point, shutdown point, those are just the topics only. In marginal costing specifically, please do the limiting factor questions. That is very important, right? In case of marginal costing, do not miss out on the limiting factor questions. That is very important. Budgetary is the summary of everything what we study in the this costing part, right? And service costing, transport, hotel, hospital, we have already covered that in the main lectures, and there is not much to be explained. Only in that case, just remember one thing in the service costing: when you are preparing the cost sheet, whether it is a transport cost sheet, whether it is a hotel cost sheet, hospital cost sheet, if you are not sure about the bifurcation of expenses into fixed and the variable part, listen to it very carefully what I'm saying. While preparing the service cost sheet, whether it is a transport, hotel, hospital, whatever the cost sheet you are preparing for, if you are not sure about that whether an expense is a fixed expense or a variable expense, please do not bifurcate, right? Please do not do the wrong bifurcation. ठीक है, छोड़ दो वहां पे, बाइफर्केशन मत करो. इट्स कूल, इट्स इजी, टेंशन की बात नहीं है, इट्स नॉट रॉन्ग, right? Just write down all the expenses monthly or annually. Another thing that you have to be careful about is that some of the expenses might be given monthly and some of the expenses might be given quarterly, some of the expenses might be given annually. You have to convert all the expenses into one period. You have to convert all the expenses into one period. That is very important, right? Please convert. If you are going to take it annually, convert everything annually. But how will you identify that whether it should be annually or monthly? It will depend upon the, in case of transport costing, it will depend upon the effective kilometers, right? For example, if the effective kilometers you are calculating for a year, if effective kilometers you are calculating annually, right? If you are calculating it annually, then your cost should also be annually. Then your cost should also be annually, right? If it is monthly, then your cost should also be monthly. So it all depends upon the effective kilometers or effective ton kilometers, whatever the value that you are finding out. If you are finding out that value annually, you have to take the cost annually. If you are finding out that value, because ultimately what will you find out? Ultimately you are going to find out the cost per effective kilometer. Cost per effective kilometer. Then if you have calculated the cost monthly and effective kilometers you are taking annually, then how can you take the cost? Can you calculate the cost per effective kilometers? No, sir. So these two things should be in the same parameter, right? Because this is a very common mistake that I have seen students committing, right? Okay, so see you guys. All the best for your examination, all the best for your preparations. Very soon we will see you and discuss whatever the paper is. Stay in touch. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.